Stop right now, because silver just did something that most people will explain the wrong way. And if you own even a little bit of it, this matters. Recently, silver experienced a sharp rally followed by aggressive volatility swings, not a smooth correction or typical down day. These are the movements that make confident traders second-guess themselves while pushing hesitant ones to jump in. So what's really happening here? Silver has entered a phase of high momentum volatility where fluctuations of 8 to 10% can materialize quickly. The market appears to be gearing up for a potential breakthrough past the psychologically significant $100 mark, with an elevated target zone around $106 acting like a gravitational pull. But there's a catch. The same volatility that could propel the next upward wave is also what eliminates late entrants and over-leveraged market participants. Without understanding the underlying mechanics of these sell-offs and market shakeouts, you risk being forced out just before the move you've been anticipating. So in this video, I'll explain the genuine forces behind this price action, identify the critical levels ahead, clarify why recent sell-offs often stem from technical factors, reveal what gold is subtly indicating, and explain why mining stocks are underperforming in a potentially bullish manner. Finally, I'll share the single principle that prevents you from transforming a profitable position into a painful loss. Before we continue, this is Julia, and I need your help with something crucial. I'm actively working to eliminate duplicate channels that copy, repackage, and redistribute content as their own. If you appreciate authentic work, subscribe immediately and leave a comment saying Julia so I can identify genuine supporters. That simple comment empowers me to push forward and clean up this space. Additionally, to maintain close contact with my real audience, I've established a WhatsApp channel, daily market updates, brief notes, video links, and occasionally my personal insights and real-time observations. The link is below. Join to avoid delayed reactions. Now, let's examine the market. Silver isn't leading because of entertainment value. Silver is leading because capital is shifting away from stagnant areas toward active ones. When equity markets move sideways for extended periods, money seeks alternative opportunities. Currently, precious metals possess the momentum. You can observe this in how attention has migrated. Silver, copper, resource stocks, miners, all climbing the priority ladder. Not because fundamentals improved, but because capital flows changed. Silver is particularly unique due to its market size. When substantial capital enters a compact market, prices don't creep, they jump. This explains why silver can appear dormant for weeks before suddenly behaving like a rocket. But rockets experience turbulence. When you witness consecutive 10% daily swings in both directions, it's not coincidental. This typically indicates market crowding. Large buying collides with large selling. Position sizes become excessive. And heavy positioning usually means the subsequent move will exceed expectations. Everyone wants the identical answer. Will we reach $100? Here's my perspective. $100 isn't magical, but human psychology is. Round numbers alter psychology. $99 feels like a chart point. $100 feels like a historical milestone. When markets approach round numbers during momentum phases, you typically encounter one of two scenarios. Scenario 1. The market breaks through, generates widespread media coverage, and latecomers flood in. This can drive rapid extension higher. Scenario 2. The market teases the breakout, then reverses violently in a brutal shakeout, precisely how maximum pain gets created. You frighten existing holders, trap chasers, and reset leverage. Both scenarios remain possible. Therefore, genuine skill isn't predicting, it's preparation. Now let's discuss the $106 zone. I'm not claiming it will happen, I'm explaining why it's significant. Markets function like magnets. Price targets become magnets because traders anticipate them, algorithms respond to them, and social media transforms them into scoreboards. Even if price never stabilizes there, it can spike toward it and reverse so rapidly your mind can't process it. So if you're monitoring silver while imagining a smooth, linear advance, abandon that notion. The journey will be chaotic. The reward, if it materializes, arrives with turbulence. This is where the most significant misconception emerges. Whenever silver drops sharply, people cry manipulation. Sometimes markets are indeed unfair, sure, but a more straightforward explanation for many sharp pullbacks is mechanical margin requirements. When volatility increases, exchanges and brokers frequently raise margin requirements. This means leveraged traders suddenly require additional cash to maintain open positions. Without it, they sell, not because their outlook changed, but because the system demanded collateral. Here's what most overlook. People leveraged in silver are often leveraged across the entire complex. If you're long silver, you might also hold gold, platinum, miners, and resource equities. When margin requirements rise, force selling spreads across the entire basket. That's why you observe dramatic candles that feel like coordinated attacks, followed by recoveries that seem like nothing occurred. The movement wasn't driven by new narratives, it was systemic plumbing. This also explains why directional accuracy isn't sufficient. If your position is excessively large or over-leveraged, a mechanical dump can eliminate you from the trade before the trend continues. Now, while silver captures the spotlight, gold is doing something meaningful in the background. Gold has been behaving more like a staircase than fireworks. Rally, pause, rally, pause. This rhythm matters because sustainable bull markets often advance in waves. You don't get straight lines, you get legs. Many traders are monitoring a zone around $5,100 to $5,200 as the next major area of interest. Not a prediction, an area where price might react. What I want you to notice is the structure: higher highs, higher lows, rising moving averages, and pullbacks that appear news-driven rather than trend-breaking. Here's the mindset shift that changes everything. Gold isn't expensive, currency is weaker. Gold is the measuring stick. The stick hasn't changed, the units you measure with did. When more dollars are required to purchase the same ounce, that's a purchasing power narrative. That's why people treating metals as long-term insurance don't obsess over perfect entry points. They obsess over remaining solvent and positioned. However, short-term, you still respect dips and volatility. You still avoid chasing. Now let's discuss miners, where people get confused. Before continuing, let me address the two most frequent messages I've received this week. First, if silver is so powerful, why does it feel like it's trying to shake me out constantly? Because the market's purpose isn't your comfort. It's to move price to a level where it finds the next buyer. In rapid phases, it finds buyers by creating fear, then relief, then fear again. It's emotional conditioning. Second message, should I hold physical metal or paper exposure? Here's my perspective. Physical is for people wanting ownership without counterparty promises attached. It's slower, calmer, and not designed for rapid trading. Paper exposure is for those wanting liquidity and quick execution, but it includes rules, margin changes, and counterparty layers that can matter at critical moments. Whichever you choose, match it to your personality. If price movements disrupt your sleep, avoid leverage. If you can't control impulses, don't chase breakouts. If you're building long-term protection, think in years, not trading days. Let me add context rarely discussed during parabolic runs. Many traders treat volatility as a signal to increase position size because they equate big moves with big opportunity. Sometimes that's accurate, but big moves also expand your risk. Your stop must widen, dollar swings grow larger, and suddenly what appeared as a modest position controls your emotions. To survive what's approaching, size down before sizing up. Earn the right to add, don't demand it. Remember this, when silver finally makes headlines again, you'll see endless stories about overheating, profit-taking opportunities, and market tops. Like every cycle, the loudest voices emerge at the most emotionally extreme moment. That's why I want you focused on structure over noise. Is the market still making higher lows? Are pullbacks being absorbed? Are selloffs occurring on margin events then recovering? Those are your signals. Back to miners. If metals are surging, why aren't miners soaring similarly? Because miners are businesses, not bars. Miners have cost structures, political risk, operational risk, energy risk, management risk. Miners trade within the equity ecosystem. Physical metal can become a global safety valve. Miners can still get sold like stocks during risk-off environments, so miner underperformance doesn't automatically invalidate the metal move. Sometimes it means big money prefers clean exposure first, the metal itself. Sometimes it means the market worries about margins. Energy costs matter, input costs matter. A rising oil environment can pressure miners even as metal prices climb. That's why miners don't function as automatic leverage. Sometimes they amplify, sometimes they disappoint. Examining miner charts, you often see patterns designed to break your confidence. A common one is the ABC correction. First drop, then bounce, then a final flush slightly undercutting the prior low. That last flush is the shakeout. It triggers stops, convinces people the move finished, then turns and runs. That's why tight stops in volatile bull markets can be liabilities. You think you're being prudent, but you're placing your exit precisely where the market hunts. So what should you do? Keep your process simple. Don't become a fortune teller, become a risk manager. Ask, is the trend intact? Is structure holding? Are pullbacks mechanical? Are flows still rotating? Are buyers stepping in on weakness? Let me bring this back to silver, because this is the core. Silver is in the zone where a single strong push can carry it through $100 and ignite crowd participation. If that happens, the next upside magnet sits above, and price can move faster than logic. But if that push fails, the market can still execute a savage dump first, then make the real move after humiliating everyone. This is why the next phase isn't about being bullish, it's about being prepared for whiplash. Here are the two biggest ways people lose money in the best bull markets. 1. They chase breakouts emotionally, oversize positions, then get shaken out on the first violent pullback. 2. They hold good positions, see large profits, get greedy, refuse exit planning, then watch gains evaporate because parabolic moves reverse violently. So the goal isn't guessing the peak, it's building a plan that survives both outcomes. If silver spikes, you already know your action. If silver dumps, you already know your response. Don't decide in the moment is designed to deceive you. Now, I want you to do two things in the comments because it helps shape my next coverage. First question, do you think silver touches $100 cleanly or fakes everyone out with a brutal shakeout first? Second question, are you stacking physical or trading paper exposure like ETFs, options, or futures? Share your answers below. One more thing, if you've achieved success in any way, business, investing, career growth, side hustle, anything that changed your life, share a quick line in the comments. People need real examples. Your story can elevate someone else's confidence today. Quick creative detour, because some of you keep requesting more inspiration content. If you want silver-related success stories, real accounts of people building wealth, learning lessons, and doing it incrementally, there's another channel linked in the description. If that resonates, subscribe to that one too and explore the stories. It's a different style, but powerful. Back to the action. This moment feels surreal because silver is a tiny market relative to global capital. When global demand activates, there isn't much supply room. Price adjusts rapidly, and that speed changes behavior. People start checking charts constantly, refreshing, doom scrolling, bragging, panicking. That's when you stop trading silver and start trading your nervous system. Here's the rule I promised at the beginning. In parabolic phases, you don't get paid for certainty, you get paid for process. Process means position sizing you can hold through swings, exposure fitting your life, a plan for volatility, and willingness to let the market prove the next step. If you're not in yet and feel FOMO, don't chase. Markets usually offer entries through dips, consolidations, and shakeouts. Patience is your admission ticket. If you are in, don't let volatility bully you into impulsive decisions. Respect the swings, but don't surrender your plan. Here's something to watch over the next sessions. If silver dips hard, then snaps back quickly, that's a sign demand is waiting beneath the market. But if silver rallies, then stalls for multiple days right under a key level, that's the market loading the spring. Both setups can lead to breakout, but the path will look different. So don't just stare at price, watch the reaction. Watch how quickly buyers respond. Watch whether sell-offs get erased or linger. That reaction speed is often the real signal. If you want me to cover specific silver setups, minor setups, or risk management examples, tell me in the comments what you're holding and your time frame. I'll select comments, break them down, and turn them into the next video. We're approaching the end, and I need to be direct. My analytics show a strange reality. Many people watch, many benefit, yet most don't subscribe. If this content helps you, support the work. Subscribe now, it's one click. If you want to back the campaign against copycats, comment Julia so I can see you. That's your badge. Also, don't forget the WhatsApp channel. The link is in the description. Join, because daily updates keep you ahead of the emotional crowd. Here's the final cliffhanger. If silver truly is entering that euphoric zone, the biggest updates may arrive clustered together, fast, chaotic, and impossible to time. The people who win won't be the loudest, they'll be the calmest, because they'll already know that volatility isn't a panic signal, it's the price of admission. So here's what I need from you right now. Do you believe silver will break through $100 first? Or do you think it will punish everyone with one brutal shakeout before the real move begins? Drop your answer in the comments below, and if this video gave you clarity, if it helped you see what others are missing, then hit that subscribe button right now, because that single click tells me you're serious about staying ahead of the crowd. Comment Julia, so I know you're part of the real community fighting against the copycats and supporting original work. Your engagement matters more than you think. It helps me continue creating content that actually moves the needle for people like you. Don't just watch and disappear. Be part of this. Subscribe, comment Julia, and let's navigate this silver move together.